Okay, let's start now. Good morning, good afternoon, and good evening, depending on where you are. My name is Arianto Patundru, and I'd like to welcome you to the day 2 of the ANU Indonesia Project Conference, Economic Dimensions of COVID-19 in Indonesia, Responding to the Crisis. We acknowledge and celebrate the first Australians on whose traditional lands we meet, and we pay our respect to the elders past and present. We are thankful for the support from the Australian National University and the Department of Foreign Affairs and Trade. Yesterday we had the political and economic updates, and today our topic is money and finance. I'm grateful to introduce Dr. Chatib Basri, Indonesia's former Minister of Finance, former chairman of the Investment Coordinating Board, and of course, one of the top economists in the region with illustrious career in academia and in policymaking. He will give the opening remarks for today's conference. Then we'll have Dr. Stephen Grenville and Mr. Roland Rajah from Lowy Institute, who will talk about monetary policy. Stephen is a former deputy governor of the Reserve Bank of Australia, and Roland is the director of the International Economics Program at Lowy. The second session will be on fiscal policy, and we're delighted to have Dr. Masyita Crystallin and Dr. Abdurohman from the Ministry of Finance in Indonesia. Masyita is a special advisor on macro and fiscal policy, while Rohman is a senior economist in the ministry. Last but not least, we'll have Dr. Blane and Ms. Ruth Nikijuluw discussing the impact of COVID-19 on the finance and delivery of local public services in Indonesia. Blane is the head of the Indonesia project and a convener of this conference. And Ruth is a PhD candidate here at the Gordon Department of Economics, ANU. Please note, there will be a combined Q&A session at the end of all presentations. And there are two ways to ask questions, by typing it in the Q&A box or by raising your virtual hand and ask it directly. So let's now start with some remarks from Dr. Basri. Dede, over to you.
Thank you very much, Dr. Patundru. A very good morning, good afternoon, and evening to all of you. It is a great pleasure to be here back at ANU virtually. Let me start my remarks by, showing some of my slides. Yesterday, we've heard from Robert, also Renata, Teguh, and also Hal about the status of the Indonesian economy. So at this opportunity, I would like to share my view regarding the policy that the government undertaken and what are the challenges. So this presentation is pretty much a sort of like a combination between theory and practice. As we know, in theory, we know everything, but little works. In practice, everything works, but we don't know why. And in the case of COVID, it's a combination of both of it. Nothing works, and we don't know. Yeah, so let me sort of like to share my view regarding the policy in Indonesia. The first question to be addressed after we heard from Robert, from Renata, Hal yesterday, what will be the recovery shape for Indonesia? Whether this would be the V shape like this or the U shape. So let me share with you the interesting. Of course, the latest data available from the Bureau Pusat Statistik was on June. But we can use some leading indicators that shows that after reopening, it's showing some July or August. The PMI, the Purchasing Manager Index, increased on August. But if you look at the retail sales, remain flat. And if you use the Google mobility data, is flat and tend to decline. And I think there are two main problems here. The first one is, as we all know already, about the weak demand. Yeah, the purchasing power problem. The second one is the external factors, because the global economy hasn't recovered yet, especially China, because our export, 40% of our export are basically coal and palm oil to China. So it depends so much on China. The other thing that we learn from the, our experience, that social distancing, it is biased in favor towards middle and upper income group if the government failed to provide social protection. Because unlike in a country like Australia, where you have a sort of like, if I remember it, call it DOL, you can stay at home, sort of like unemployment insurance. We in Indonesia, we don't have the unemployment insurance. So the people could stay at home if only they have savings. If you don't have enough savings, then you have to work. So unemployment is a luxury goods. Only the rich people could afford to be unemployed. But if you are poor, you have to work. Yeah. So that is why, if you look at the pattern in the middle lower income group, yeah, immediately after the reopening, they went to the market. So if you look at the traditional market like Pasar Majestic, Tanah Abang, immediately recover, and they spend money. Yeah, but the problem is the purchasing power is relatively low. Yeah, on a middle income, upper income group, they have the luxuries to choose whether they would like to stay at home or going to work, or do some leisures like visiting shopping mall or something like that, because they have savings. But interestingly, a survey conducted by Bank Mandiri, yeah, shows that the visit of shopping mall post reopening is still less than 50%. Yeah, so the middle and upper group, they don't spend money that much. Yeah, so the problem is with this middle lower income group, they spend money because they have to work, but it's not enough because the purchasing power is weak. The middle upper income group, because they are concerned about the health issue, etc., they don't spend much money. And then if you look at the data on savings, the third party fund is increasing now. Yeah. The other explanation is because the change of behavior. Some people start to do the online shopping. Yeah. Now, in the last 1 month, I think there's been a discussion about vaccine, and hopefully by January 2021, we will have vaccine available. But the problem is we probably need to do a little math on this. The first question is, which society will get the vaccine first? Maybe the focus will be on the aging population, aging group, or the people with the comorbid, diabetes, etc. And the number of the estimation, according to the government number, is about 25 million. If you look at the 25 million divided by 365 days, the government should do 68,000 vaccine per day. But in fact, the capability of government doing the PCR test now is only 20,000. So even 1 year after 2021, yeah, it's still very difficult to distribute the vaccine. Yeah, so that is why maybe the recovery will be in the U-shape. And the other thing is, with the health protocol still in place, it is very difficult to achieve the break-even point. So now the economy start moving, but with if they cannot achieve the economies of scale, then there will be a problem for them. Yeah, because maybe in the next couple of months, it's very difficult to cope with the overhead costs. Now, under that kind of situation, what should we do? Yeah, the external sector is weak. The real challenge is whether the private investment will kick in by 2021. And if you look at the loan to deposit ratio is declining because there is not much demand for credit now, as savings increase. So the issue is more on the credit crunch rather than liquidity. The banking sector doesn't want to lend the money. So what would be the option for the government to induce as a jumpstart. I conducted a sort of like, the impulse response function. Let me try to speak in the human language. If we increase investment, the private consumption will increase like this one, the red line. But if we boost consumption, the investment will increase like the blue line. So it is very clear that if we want to do the jumpstart, we should induce the consumption first. Yeah. So that is why the role of the fiscal stimulus as a jumpstart is very important. I don't think the monetary policy will help, because even you lower the interest rate, if the demand is not there, then will not help to boost the economy. So the solution is the government should extend the cash transfer to the lower middle income group. And then they already have this recovery program, the credit guarantee, interest rate subsidy. Now, let me move to my last slide. Policies in the second best world. The problem is with the fiscal policy, because everything that I mentioned earlier, we need money. How do we finance the deficit? Yeah, we already know that there is a limited domestic pool of funds. And if we go to the international market, I believe that Masyita later on will explain about it, high yield in the international market. If we go to the IMF, there is an issue about the IMF stigma. If you go to the CMIM, it's still untested. So the option that available for Bank Indonesia, for example, they went for the bilateral swap. Yeah, that's one way to get the extra budgetary support. The other thing, I do believe that Steve and Roland will discuss about it, the burden sharing with Bank Indonesia. The reaction from the market, as long as the size is limited, tradable, and clear time frame, and then using the market rate, that will be acceptable. Yeah, I believe Steve and Roland will explain about it. But the biggest problem now, even though we already have this source of financing, the ability to spend as of July is still very limited. The budget deficit as of July only 2%. Government revenue dropped by 12.6%. So mostly the deficit were driven by the drop of the government revenue rather than fiscal stimulus. And the absorption of the program, the Pemulihan Ekonomi Nasional, was only 27% as of September. So the issue is the government still very difficult to spend the money, even though the financing is there. Why is that? The 98 and the century case trauma, indecisiveness due to fear of the corruption and coordination problems. Yeah, the people in the bureaucracy, they are worried to make a decision, especially if the data is not available, something wrong, the Supreme Audit will step in, the KPK will step in. So the ability to spend the money is limited. The other thing is the cabinet just was formed on October, and then probably they don't have enough time to learn about how to run the bureaucracy. On February, already work from home because COVID. So even designing the budget become a problem. The other thing is data on the social assistance only available until 2015. So that is why somehow we need to identify the so-called aspiring middle class using the non-conventional data. If we stick with the old data, then it will be very difficult because the data only available until 2015. Maybe the government should think to use the data from telco, community-based, or maybe you can use the Kartu Prakerja. I do understand that people always think that this Kartu Prakerja is useless, but you can use as a selective selection criteria. If this online training is useless, then you don't want to continue with this training. If you stay, it means that you need the money. Yeah, but if you have money, you will drop out from the online training. You can use this as a selection criteria. Last but not least is the getting pandemic under control should be the top priority. Yeah, so I think in this particular issue, the government should be pragmatic on policy and how to work within constraint. If you are talking the data is not accurate, there is a coordination problems, etc., then let's focus on something that can work. Let me give an example. If the absorption is still a problem, look at among the spending, which one is the most effective one? Is social assistance. Why don't we just focus on the BLT? Yeah, and then after the demand is there, let's move to other sector or other policy. Last but not least is fiscal discipline and fiscal stimulus. If the private sector not kick in by 2021, I think the government needs to make a decision carefully whether they should withdraw the fiscal policy earlier or not. Yeah, because otherwise, if the demand is still weak, then maybe they should continue with the fiscal stimulus, 2022 or even 2023. I do understand that the theme of the fiscal policy all over the world is whatever it takes, and there is a risk of that issue. But don't forget, 2000 and the year 1999, we had the debt to GDP more than 100%, and we were able to manage it to make it less than 30%. I leave it up here. Thank you very much.
Thank you very much, Dede. That was a very good segue into today's topic. So now let's move to the thematic presentations. For all the presenters, please note that you have 20 minutes for each presentation. Please expect time reminders from me. And now I'll first call on to Steve. Steve, over to you.
Much. You can hear me?
Yes.
What a pleasure it is to be here and talking to such a huge audience, and in Indonesia that makes it doubly a pleasure. And to have Dede to guide us, bringing his long experience and intimate policy understanding. So we've got some slides up?
Not yet, Pak.
Slides up?
Not yet. Yeah, it's on now. Okay.
Slides up?
Yes.
Sorry for the delay. I'm still an amateur here. Now, monetary policy has a limited role in addressing the COVID crisis, as Dede said. The main challenge will fall to fiscal policy. But that said, Bank Indonesia has two important tasks. First of all, it has to ensure the continuity of short-term portfolio inflows, which fund both the budget and the external deficit. This is the job of financial stability, including the balance of payments. The second job is that Bank Indonesia has to help fund the bigger budget deficit, which COVID makes necessary. What's Bank Indonesia done so far? Interest rates are down and liquidity has been added to the system. But as Dede says, there's no demand for credit, so this is not going to have a huge effect. Perhaps more importantly, OJK, the fiscal authority, is offering what in the jargon is called supervisory forbearance. In other words, they're going soft on regulation so that troubled borrowers can remain solvent during the COVID slowdown. All well and good. Now, the main problem of fiscal stability comes from foreign capital inflows, especially the foreigners who have bought Indonesian government bonds. Now, what's the problem? The problem is these foreign investors are fickle and flighty. Indonesia relies on short-term foreign capital inflow to fund both the budget deficit and the current account deficit. Just want you to feel the general message of this graph. There are regular sudden stops, actually capital reversals, which come 2008, 2013, the famous taper tantrum, 2015, 2018, and now in March earlier this year with the COVID. The three earlier episodes shown here, and these just show the characteristics of the episode. Every time the foreign capital goes out, the exchange rate depreciates, usually by about 15 or 20%, despite the fact that Bank Indonesia does quite serious intervention in the foreign exchange market. You can see the dips in the blue line here, which is showing Bank Indonesia's intervention. Despite this, the green line, the exchange rate, still goes up. And of course, the bond yields also change. They move in the wrong direction. Before COVID, bonds were sitting at around 6.5%. That is the amount of interest which the government has to pay on bonds, 6.5%. It moved up over 18. Now, what happened initially with COVID in March? Here's the latest sudden stop, actually reversal episode. The big part of the capital inflow consists of foreigners buying Indonesian government rupiah-denominated bonds. Look at the action in the red bars. They're called here IDR govies. The financial market people always like to make up little names for things. You can see the red bars tracking along quite nicely in the positive area. Then in March this year, a huge outflow and hardly any return. This has been, the shortfall in the red bars has been made up to some extent by government borrowing overseas, which is good, it's more stable for a start, but the volume's limited. So here's the message for the first couple of graphs. Indonesia has learnt to handle these reversals pretty well, with Bank Indonesia intervening in foreign exchange and bond markets to stop the more extreme movements. Exchange rates and bond yields generally revert, in other words, come back to more or less where they started from. So here's the situation so far. So far, so good. But the outflows in this episode were much larger, and Bank Indonesia's direct purchase of bonds to hold up the bond market were much larger this time. So the downgrading of the credit rating would be very serious. The important point here that these flows depend on maintaining foreign confidence. I should repeat it a few times because this is the important message here, maintaining foreign confidence in the bond market. And if the foreigners can't be relied on to buy government bonds to fund the anticipated bigger budget deficit, then who will fund it? So that's a segue into the second Bank Indonesia task, funding the deficit. Indonesia has a long tradition, 50 years or more, of fiscal rectitude. In other words, constraining the budget deficit and constraining Bank Indonesia from funding budget deficits. You don't have to go to foreign countries to illustrate the dangers and disasters that occur when central banks fund budget deficits. Indonesia has an early history of exactly this. In the 1960s, the Sukarno policy. The budget deficits were not the only problem in this period, of course. But by 1966, the economy had collapsed. And with huge budget deficits funded by the central bank, there was 1,000% a year inflation. Reflecting this traumatic experience, the very first thing which the New Order economists under Professor Wijoyo did was to put in place a balanced budget rule, 1967. I can remember it, the colonel that was put in charge of the budget, he said to me that he only handed out money which had come in from, he handed out money with his right hand that had come in with his left hand. A very strict budget balance rule right at the beginning of the New Order. And then later on, an extra safeguard rule was put in place. Bank Indonesia can't be forced to fund the deficit. And this was formalised by a rule banning direct bond purchases by Bank Indonesia, and it was backed up by Bank Indonesia independence in 1999. So the second dot point, I think Pak Dede made it very clearly. These are very urgent times as far as budget expenditure goes. Somehow the funding must be found. So the fiscal need is great and the alternatives are very limited. Both these constraints that I mentioned a moment ago have been relaxed. Already the budget rule had been changed so that a deficit of 3% was allowable. That's now been moved back quite a bit further. And the second constraint that stops Bank Indonesia from buying bonds at the primary tender has also been lifted. So what's happened? Bank Indonesia always bought some bonds in the past. We saw during the episodes of capital outflow, Bank Indonesia actually did intervene in the bond market. But now it's agreed to buy bonds at tender, called standby, just to make sure that this bigger budget deficit can be funded. And it will buy some bonds directly from the government at yields which provided what's being called burden sharing. Crisis times justify unconventional actions. But we should recognise and just think for a moment about just how fundamental is this break with conventions and constraints. And that provides a very powerful reason for limiting and giving an exit strategy for these policies. Let's look more closely at the idea of the central bank buying government bonds to fund the deficit, often called money printing. Money printing has actually become quite routine since the global financial crisis in 2008 in the rich countries. And recently, many of them have moved to the next stage, which I think the best term is money-financed budget deficits. In other words, the central bank is funding the budget deficit. It's also called overt monetary funding. And these have become, I'd have to say, quite common in the rich countries. They're becoming common in emerging economies also, although Indonesia's proposals are considerably larger than most of its peers. Why is this so controversial? There's a belief that this kind of money printing is a free lunch. People really honestly believe that this money is free. This is often associated with MMT, modern monetary theory. The key point to understand is that the mechanism at work here is that the central bank, whenever the central bank purchases bonds, it creates central bank money, that is often called base money in the textbooks. This circulates in the economy and ends up mostly in bank reserves at Bank Indonesia. What concerns does it raise? Well, the first concern is that this understanding that it's a free lunch is simply wrong. It's not a free lunch. It's the bank reserves which are placed at the central bank, and the central bank actually pays interest on these. It pays either 3.25% or 4% in Indonesia. What about inflation? Milton Friedman taught us that money always causes inflation. That might have been right 30 or 40 years ago, but it's clearly not right now. These rich countries have managed to do a huge amount of money creation without it causing inflation. So it's not true that that inflation is always a monetary phenomenon. So inflation is something we should always be concerned about, but given that demand is slack in all these countries, it seems to me fairly unlikely that we'll have any inflationary problems anytime soon. Maybe further down the line, but not anytime soon. Now, what about budget profligacy? This is a slippery slope. Anytime the parliamentarians think that there's free money available, they will tend to run budget deficits. It also may distort the financial sector. You can remember Ronald McKinnon talking about financial repression. If you load up the bank balance sheets with reserves, and perhaps they'll even buy the bonds themselves, then they can't be lending to other people. So they don't have enough money to lend for other good purposes. And of course, we seem to have taken away some degree of Bank Indonesia's independence. So this is another worry. There's the critical question of burden sharing. Bank Indonesia is actually paying some of the interest on this borrowing. The first thing to understand is that Bank Indonesia's profits always get paid back in due course back to the central bank, back to the Ministry of Finance. So if you take the interest costs out of the budget and put them in Bank Indonesia, you're just delaying the effect of paying the interest. Later on, Bank Indonesia's profits will be smaller. Over the past month or so, it's become apparent that this is not a once-off operation. The 6.3% budget deficit this year will be followed by a 5.5% of GDP budget deficit next year. So there's no post-COVID quick return to normal. So Bank Indonesia needs an exit strategy, and it doesn't have one. And now there are some new developments in the very recent weeks that it's proposed that legislative changes are proposed by the DPR. They would formalise, that is, make permanent, the money financing of the budget to make it routine rather than once-off, including the burden sharing component that I criticised a moment ago. I think maybe the DPR and perhaps even the government itself is motivated by the myth of cheap budget finance here. Governance is the next critical issue. The suggestion is that this be changed so that the Monetary Council is in charge and the Minister of Finance is the chairman of the Monetary Council. So this would move the decision-making process outside Bank Indonesia, take away its independence. There's also other changes. Employment is an objective. Banking supervision might return to Bank Indonesia from OJK. Individually, these proposals are not disastrous, perhaps second best. But changes in governments and formalising the overt monetary funding of the deficit is moving in the wrong direction. To make this point strongly, I want to finish with some history. History doesn't repeat, but as Mark Twain said, it rhymes. Governments for centuries have used their central banks to fund their budget deficits, and it's often turned out badly. Whenever we think of money-funded financing, we think of the Weimar Republic, Germany after the First World War, where budget deficits were funded by the central bank and set off spectacular inflation in 1922 and 1923. You needed a wheelbarrow to carry the amount of money needed to buy a loaf of bread. In the end, it took the exchange rate with a dollar was 11 trillion Deutschmark to the dollar. And this hyperinflation, this incredible hyperinflation, was brought to an end by a remarkable man, Hjalmar Schacht, at the end of 1923. He brought it to an end in just a month or two. He went on to have an amazing career as governor of the German central bank and minister under Hitler, I might add. But the thing that strikes me as being the reason why I want to quote him is it's a remarkable quirk of history. He visited Indonesia in 1953, 30 years after he had stopped hyperinflation in Weimar, Germany. He came and visited Indonesia for 3 months. He wrote a detailed report of advice to the infant Indonesian Republic on how to run its economy.
3 minutes, Steve.
Look, we need to go back. Here we are. Here's an attachment. Here's a part from his report. I won't read it all. You can do that while I'm talking on other things. I'll just go straight to the last line. To have recourse to the central bank threatens the stability of the national currency. In other words, he was saying, if you get the budget funded by the central bank, you will have inflation and an exchange rate. My guess is that the greatest immediate danger to Indonesia today is not inflation, but rather the loss of the fragile foreign confidence in Bank Indonesia's independence, with resulting capital flight. They'll be looking at the 3 points that Dede mentioned earlier. Is the funding tradable? Does it have a clear time limit? And is it all happening at the market rate? While Bank Indonesia's original agreed funding, $40 billion or so, had risks, these seem to be worthwhile risks and was accepted by foreign markets and rating agencies. But it's important when doing unconventional, unorthodox things to do them in the most orthodox way possible. So this is why I raise this question. Is this the right time to rejig the financial sector and make overt budget funding a permanent feature of Bank Indonesia's task? Why now? Bank Indonesia's original proposal back in April seemed to strike the right balance. The recent DPR proposals are teetering on the brink, the slippery slope into persistent unfunded deficits and a compliant central bank. Crises are dangers and opportunities, time for policy reform, but they're also time for serious policy mistakes.
Sorry, Steve, you might need to speed up a bit.
I finished.
Well, thank you so much. So that was on the monetary policy, and now we move to fiscal policy. And I'd like to invite Dr. Crystallin from Ministry of Finance to start her presentation. Masyita. Is Masyita there?
Okay, can you see my screen
Yes.
now?
Yes.
Okay, good. But I cannot see the screen, so that's the problem. Hold on, Mas Aco. Can I have the screen share from there? Because I cannot see the...
Okay, if you want to stop sharing from your end, Dodi will share your presentation. Okay.
Oh, I saw it already. Okay.
Okay, this is from our end, I think.
Oh, already
Yes.
from your end? Okay.
Yes.
All right. Good morning, good afternoon, and good evening for everyone joining today's session. My colleague Abdurohman and I are proud graduate of ANU. In fact, Mas Rahman has covered all base, right? He did bachelor in UGM and then master in Illinois and then a PhD at the ANU. So he got all the mafia covered under his wing. Let's go directly to slide number 2. So I think a lot has been covered in the previous one, impact to the economy. I'll cover impact to the economy, directly to fiscal policy response, and also how we finance the recovery and some lesson learned for future reform. Next. So basically, COVID has started in Wuhan at the end of December, right? But market was still dreaming that it's not happening. In fact, market was still over-optimistic. There's a huge inflows into emerging markets starting in the fourth quarter last year. So a lot of the international organization was saying that 2020 is going to be higher global growth, better capital flow to emerging market, etc. And market is still over-optimistic up to February, mid-February. In fact, when the WHO announced the pandemic status on March 11, market was still at the highest level, right? Market started to crash on March 20. So there's always a lag and a little bit of decoupling between what happened in the financial sector and in the real sector, especially if you're looking at the high frequency indicators. I've laid out here several of the indexes. Usually finance people use FIX to show volatility, but FIX is more on the asset side, but I use MOVE here, MOVE Index by Marilyn. This shows the volatility for global bonds, especially from emerging market. You can see that all the heightened in volatility happening at the same time, and starting April, all these indicators has started to calm down a little bit. In fact, if you look at the capital flows into emerging market on the right-hand side chart, you see there's a quite a slope, yeah, going back to emerging market. What happened in March and April was that if you're looking at the global portfolio allocation, global investors were prefer to hold cash rather than assets. And then they started to enter the advanced economy instrument, and then finally going back again into emerging market. However, if you look at the dark chart, the red line on the bottom, I took this from Citi Velocity. This is only from Citibank clients. You can see that if you're looking only real money, yeah, because the above is all capital flows, including the hot money. If you're looking at real money, the rebound is flat. You can see that the slope is almost flat. Next. So I was saying that there was incidence of decoupling, especially when you look at the high frequency indicators like retail, mobility indices, consumer confidence, etc. If we see what happened in not so high frequent data like growth, you can see that the trajectory are similar, but obviously different in magnitude. So Indonesia growth only growing at 3%, potential growth around 5% in the first quarter, and contracted at 5.3% in the last quarter. If you're looking at compared to other countries, of course, this is in comparison is not too bad. However, you can also say that come 2021, when other countries have low base effect and they're gonna have higher growth if vaccine were found or this physical distancing proved to be useful, then all other countries for example, like in Southeast Asia comparison, will grow at a higher level than Indonesia, right? That's also create, because with the global investors, it's always a beauty contest. There's nothing fixed, right? Which one is prettier at certain circumstances? That monetization can be bad, but it's not so bad when everyone is doing it. It's just a matter of whether market believe that you're gonna do only one off and you're gonna do only a small portion. That's what the Indonesian government and Bank Indonesia is trying to do. So on the growth indicators, you see similar patterns, but if you also looking at the high frequency indicators, usually the purchasing manufacturing index has already started to rebound. I only put one chart here, the global PMI, but if you're looking across all advanced economies and emerging economies, you see the same pattern, it's just different numbers. For Indonesia, in July, we finally reached a positive territory. We reached 50.8, meaning that we're already in the expansion zone. But of course, talking about high frequency indicators, 1 month of data, you cannot really, say that the rebound is happening. Next. So the impact is similar. Before this? Okay. The impact is similar and the response are also similar. So policy response, I will not cover the monetary, but more or less the same. All are doing monetary easing, all doing unconventional monetary policy. As mentioned before, usually this is only the territory of advanced economy. Now emerging economy has started to do so. And in the case of Indonesia, I should say that we done quite well so far with the transparency with the market, assurance that this will be one-off, and the magnitude that is not too large as comparison to GDP compared to other countries, right? Remember, because this is always a beauty contest with the global investors. So, but in the fiscal front, there are several measures that are similar. For example, expansion of social safety net, both on the coverage and the number, and then also in the beneficiaries. Different subsidy, for example, like electricity subsidy, Indonesia did that, and also several other countries. Tax incentives and supports to small, medium enterprise, supports to local government. The Fed, for example, has started lending directly to states. Indonesia has also pinjaman daerah now. And of course, loan restructuring, and we also have interest rate subsidy as well as working capital loan. Next. So if we're looking at the impact to the Indonesian economy, of course, consumption and investment. Consumption accounts for 57% of Indonesia GDP, and investment is around 30%, contracted significantly. Consumptions for food, that is not restaurant, still growing positive, but all other types of consumption, except IT infrastructure and also health spending, are in the negative territory. Investment also growing at negatively at more than 8% of contraction. For investment, the government tried to continue projects that are ongoing. So for example, if you have an infrastructure project that already ongoing, it will not be canceled. So we learned from what happened in the Asia financial crisis, where there's a lot of projects being stopped or mangkrak. So it's a wasteful. Now, because we understand this year the fiscal burden will be tough, what we're doing is that we extend the completion of the project, so the cost to this year's fiscal budget will be more moderate. So the outlook for 2020 for Indonesia growth overall will be around minus 1.1% to 0.2%, with risk tilted more to the downside given the current circumstances. Next. Now, here I would like to tell a story that fundamental matters when we design the policy, especially the current fiscal policy. So if you're looking at this chart, I'm sorry, I put too much information in one chart. So the x-axis show the GDP proportion of each of these sectors. And then the size of the circle is the number of employment. So you see three giants there, manufacturing, agriculture, trading services. And then the lower your position in the y-axis, the higher the informal sectors or informal labor in that particular sectors. So you see these three giants, not only that they're slow, they're growing lower than the economic growth even before the pandemic, but they also have a high proportion of informal labor and informal sector. The green sectors, these little dots on the left-hand side, are the winning sectors. These sectors is relatively high value-added sectors, service sectors that are doing well even before the pandemic and after the pandemic. So the green sectors grow above economic growth before and after the pandemic. So these are the winning sectors. So if Indonesia would like to escape the middle income gap, middle income trap, and want to go above Indonesia potential growth, and these are the sectors that we will focus on in the future. The blue sectors is a relatively lower value-added services sector, also has a lot of informal sectors, informal employment within the sectors. These are the affected sectors. These are sectors that are affected by physical movement. So these sectors grow above potential, above economic growth before the pandemic, but because of the physical distancing has grown low. Looking at this characteristic of the Indonesia economy, and Pak Dede has already mentioned, 40% is commodity to China. In fact, 55% of the export basket is still commodity, raw commodity. then you can see why the fiscal response is designed more towards helping through expanding the social safety net, especially direct cash transfers. Because a big part of the economy is informal in these sectors, and these sectors are growing very slow. And then second, we see that these big giants are labor-intensive sector. And that is also why the fiscal measures are aiming for the real sectors, are aiming first for the labor-intensive sectors. Next. Pak Dede has already covered the U, V, L. Some even worry about a W shape if you have a second, third wave. But let me just point out to the right-hand chart. This is Bloomberg Mobility Index. So they combine several mobility data. There's no Indonesia here, but I just want to point out the fact that it's going to be a long recovery process. You can see that even in the mobility, we haven't translated this to economic activity and GDP, etc. Right? This is just the mobility that the pick up is not going back to previous level, one, and number two, that the slope has already flattened early in the recovery process. So this look like more like a L shape or a very long U recovery. That's why the fiscal policy and any policy response have to be ready with the fact that, you know, we have still to be ready with the worst case scenario, although we still hope for the best. On the left-hand side, pardon with the bahasa, I haven't translated that. This is the revenue, monthly revenue by sectors. You can see all sectors, manufacturing is first, perdagangan, trading services, and financial services. Almost all major sectors, the big giants, and also the most competitive one in terms of tax revenue has contracted significantly, showing that, you know, this year recovery is going to be tough for Indonesia. And looking at the global trend on the right-hand side chart, that is going to be a long game for everyone. Next. Given that context, right, the structure of the Indonesian economy, the trend of the pickup in global growth and global economic activity, I even haven't mentioned the global supply chain and how it stopped. The economic recovery program was designed based on those facts, right? First, the focus of the president is, number one, is health measures. And number two is demand stimulus and also supply side support. For demand stimulus, I have discussed previously. You can read the detail later. Basically, it's expanding social safety net, giving electricity. We have data, unified database for receiver, the beneficiaries for social safety net, DTKS data, for almost the bottom 40%. But there's a lot of room to improve this data set. For example, the update of the data, and then also it still have exclusion error, which is more dangerous than having an inclusion error at the time of pandemic. And then also on the demand side, we have subnational government support, including lending directly to subnational government from the Ministry of Finance. And we have sectoral support to other line ministries. On the supply side, we're doing the biggest chunk was the small medium enterprise support. And then in the middle, on the corporate financing part, the big chunk is going to labor intensive sectors. So for the manufacturing, we divided the labor intensive and non-labor intensive. And then finally, the tax incentives given not only for corporate tax, but also for income tax to lower the burden of everybody. Next.
3 minutes, Shita.
Yeah. So a fiscal challenge. So we have to do fiscal consolidation in the middle of increasing debt ratio, right? So the debt ratio here I show with the new perpres, so the new budget, it increased. Of course, if deficit higher than expected, this will be higher. But looking at fiscal sustainability in Indonesia, actually in the past 4 or 5 years, Indonesia is in a trajectory of improving the primary balance, as you can see in chart number 3. So we're already close to zero. In fact, we plan to have a positive primary balance already by 2020 before this happens, right? tax ratio will of course decline because of the pandemic, but there's a lot of story behind this tax ratio. There's a lot of fundamental issues as well. I mean, before COVID, tax ratio has already declining because of declining tax base and commodity price, etc. Next. I'll skip this. Yes, burden sharing. So with this heightened burden, the government and Bank Indonesia is working together to do a burden sharing mechanism. So the first mechanism is for the public good expenditure. These are all covered by Bank Indonesia, 100%. The rate paid is BI reverse repo rate. For the non-public goods, we have market rate. So this is market rate, it's not a discount rate. BI bear part of the interest rate and the government bear part of the interest rate. And the other expenditure also at market rate, and government will bear 100% of the interest expense. So unlike, you know, sometimes people say burden sharing, they just assume directly to the other expenditure where, to the public goods expenditure where BI cover all. But actually the non-public goods part, other expenditure and public goods, we maintain that the instrument is tradable, so it later can be used as monetary instrument once economic condition is better and BI need to absorb this liquidity from the system. So it's tradable and it's based on market. So it's still going to several market mechanisms like green shoe, private placement, etc. Last slide, please. Next one. So we draw some conclusion and some lesson learned. Basically, on one side, we need to improve revenue collection with revenue reform. On the other side, next slide, please. On the other side, we also have to improve the quality of spending. For example, you know, reducing subsidies, like commodity subsidy is always regressive. So that has to be reduced and go directly to, for example, direct cash transfer for social safety net. Because I charted here on the right-hand side, a lot of the different type of subsidies still goes to, you know, people above the bottom 40% who's not supposed to get it. So it's inefficient. And better data management, for example, the DTKS has to be updated and has to include more population, by name, by address, and including account number. I think that's all for me. I'll be happy to answer during the Q&A session. Thank you.
Thank you so much, Masyita, and thanks for keeping up with the time. So let's now move to the next presentation on the impact of the COVID-19 on the finance and delivery of local public services in Indonesia. So let me call on to Blane to start his presentation. Blane?
Yeah. Okay. Thank you, Acho. Okay, hold on a second. Now, just want to get back to where we were. There we go.
You're starting from the end.
Yes, almost. I want to skip right to the punchline. Thanks very much, Acho, and thanks everybody else for joining today. I'm here with my co-author, Ruth Nikijuluw, a PhD student here at ANU. This is our presentation based on the chapter that we're writing for the COVID book. I'll run through the presentation, and Ruth and I will both be here to answer any questions that you may have. So what we're looking at is the impact of COVID on the impact of COVID on the finance and delivery of local public services in Indonesia. This is the scheme for the presentation today. We want to start just with some general stylized facts about what's happening to local service delivery under COVID. Then we'll look at the objective of our presentation. A brief couple of slides on the geography of COVID and the role of subnational governments, some of which has been covered by earlier presentations. And we'll look very quickly at the conceptual framework that we're using to examine the impact of COVID on local public services. This works through a number of intermediate impacts, economic growth, central government revenues, intergovernmental transfers, and then on to district spending along with household spending. And then finally, we want to look at the impact of those intermediate effects on household access to services. As usual, we have a number of caveats regarding our analysis and conclusions. And then we'll look briefly at the government policy response and comment on that, and finally conclude. So if you read through the Indonesian press, both the national press and regional newspapers, which is really quite interesting actually, and you look through what the IFIs are saying and the bilaterals are saying, these are the kinds of points that come out. They're qualitative assessments of the impact of COVID on local services, but these seem to be the broad conventional wisdoms. You know that when schools moved online, there was almost an immediate decline in participation in schooling. And the phased reopening of schools in the so-called green and yellow zones has not really helped to constrain that decline in school participation. We saw yesterday during Robert and Teguh's and Renata's presentation that utilization rates, health utilization rates have been declining quite quickly under COVID. And this is true for both puskesmas and regional hospitals. So people are using those facilities less frequently than they used to, accessing those services less frequently. And you also see some talk about what's happening to improved water and improved sanitation. It's not clear whether there's a reduced access to water and to sanitation or whether the access is just slowing a little bit. But nevertheless, these are concerns as well, both access to improved water, sanitation, meaning toilets, and treated wastewater. And these things are helping to exacerbate the spread of the coronavirus. So what are the reasons behind those conventional wisdoms? There may be many. The ones that we are focusing on today are the first two there. Perhaps the district provision of public services is deteriorating because of cutbacks in intergovernmental funding in particular, and households' ability to pay for services also worsening because of reduced income and consumption. Those are two plausible hypotheses which we want to look at today. So what would the solutions be? Obviously, you should increase funding to districts and expand income support to households. Of course, local governments themselves, district governments are, if you read the regional newspapers, for example, are demanding more in the way of intergovernmental transfers. That's their solution. So what we want to look at today in this presentation is to examine the impact of COVID on the finance and delivery of district public services. We are looking at two channels in particular, two mechanisms. That is district spending, especially as a function of reduced intergovernmental transfers, and household spending. So we want to look at the impact of COVID through those two mechanisms on household access to education, health, and infrastructure services. I'll give you the punchline up front. We find a rather modest effect of decreased district and household spending on local public services. This is not to say that access to services has not declined significantly. It may have, we just don't know yet what the impact of COVID has been on access to services. But if it is severe, our argument is it's not because of reduced district spending and reduced household spending. And we'll get to why we think that is the case later in the presentation. So first, a couple of bits of information on the geography of COVID. We know that it has spread to all 34 provinces at present, and according to the data, 489 out of the 514 districts have reported COVID cases. Most of those cases, in the aggregate at least, are concentrated on Java, as is well known. The per capita caseload is especially severe in Jakarta and South and East Kalimantan. Here you can see the map. This is the cumulative confirmed cases of COVID by district. The darker red you get, the worse it is. So you can see obviously especially around Jakarta and East Java, on Java in general, is where a lot of cumulative cases have been concentrated. In per capita terms, it's a slightly different story. Per capita terms, you see East Kalimantan suffering severely, along with some places in Eastern Indonesia on a per capita basis. Jakarta is still pretty bad, as is Eastern Indonesia. The role of subnational governments, it's the usual sort of tug of war between the central government and subnationals. Subnationals may lead mitigation efforts, but only under strict guidelines provided by central government. I must say that some of those guidelines have not been particularly clear, at least from a subnational government point of view. So there's a little bit of chaos regarding who's supposed to be doing what. Districts are responsible for the large-scale social restrictions, but only after securing Ministry of Health approvals, in theory. Nevertheless, district task forces guide the overall local mitigation efforts, and Puskesmas are responsible for the initial screening of cases, contract tracing, monitoring of suspected cases, and surveillance testing in general. MOF has also instructed subnationals, both at the provincial and the district level, to reallocate their budgets to respond to the crisis. So here is the conceptual framework that we're using to examine the impact of COVID on local service delivery. You see the supply side effect, as is well known. COVID first has a supply side effect on the business community. Businesses are shut entirely, or they are restricted in their operations because of social distancing measures. That supply side effect then has an impact on the demand side, that is on households. People are laid off from work, or their hours have been restricted, or sometimes they are also sick and pass away, which reduces household income and expenditure. But what we're interested in really is the impact of COVID through business activity on GDP. And then we follow this horizontal line here, the impact of the negative impact on the growth rates of GDP through central government revenues, then through intergovernmental transfers, on to district spending, and ultimately on to local service delivery. So it's the box DEXP, that's district expending. Sorry, I jumped a little bit too far ahead there. And household spending on services. So this is our general framework for the analysis today. So we'll start with the intermediate impacts, work our way through that main horizontal line. This is somewhat of a moving target, as everybody knows. In 2019, the economic growth rate in Indonesia was around 5%. Currently, or at least as of the end of August, the Ministry of Finance was estimating that the economic growth rate in 2020 may decline to somewhere between 0.2 and minus 1.1%. So that suggests that the change in the economic growth rates between 2019 and 2020 is somewhere between minus 4.8 and minus 6.1 percentage points. There are a variety of other kinds of estimates of economic growth for Indonesia in 2020. I've listed just a couple of here. World Bank is currently forecasting zero growth. The IMF minus 0.3% for growth. ADB minus 1. So what we are taking in our estimates here is the midpoint of government's growth projection. That's our working estimate, suggesting a decline in the economic growth rate of minus 5.45 percentage points. So here's what happens to central government revenue. You see at the bottom is the current forecast of central government. The Ministry of Finance estimates that government revenues in 2020 will drop by about 21.5%. Now, the information at the top, we thought it would be instructive to look at what has happened to central government revenues during past crises. So you've got the Asian financial crisis there on top and just below the global financial crisis. You see, during the Asian financial crisis of 97, 98, the drop in the growth rate was rather severe, almost 19 percentage points. And then over on the right-hand side, you can see that the change in central government revenues during that time was about 21.1%. Now, the global financial crisis was less severe in terms of its impact on economic growth, somewhat of a non-event for Indonesia. It was only a 1.3 percentage point drop in economic growth between 2008 and 2009. Nevertheless, central government revenues in the aggregate declined also quite significantly to about 20.1%. So you see the current forecast of government, the drop in revenues at the central government of 21.5% is quite similar to the instance of what happened in both the previous recent crises. On intergovernmental transfers, we only look at what happened in the 2008-2009 crisis because the Asia financial crisis occurred before fiscal decentralization took off and is a bit less relevant. You see there on the top line what happened, again, is just a repeat that central government revenues declined by about 20%. Intergovernmental transfers, that's on the expenditure side of the central government budget, declined by about 3.5% in the aggregate. And currently, the Ministry of Finance is estimating that intergovernmental transfers, that's not including the transfers to villages, Dana Desa, will decline by about 8.5% in 2020 from the 2019 levels. So slightly more than happened during the global financial crisis. You'll note that many of the transfers to subnationals are tied directly to various kinds of central government revenues. So they are, in a sense, the automatic stabilizers that Hal was talking about yesterday. Transfers from natural resource revenues, tax sharing, those are just passed through. Those national revenues are just passed through to subnationals. The general purpose grant, or the DAU, is also connected directly to net domestic revenues. A minimum of 26% of net domestic revenues are transferred to subnationals via the DAU. The DAK, the special purpose grants, are the major set of other transfers that are not linked explicitly to central government revenues. So that is the most discretion that the central government has over intergovernmental transfers. In any case, we're looking at about an 8.5% decline in transfers this year. That's not small. It's a pretty big amount, but it's nothing like the decrease in revenues, say, in other parts of the world. In the US, for example, if you look at what's happening to state and municipal budgets, you're seeing between 15 and 20% drops in revenues for those places. So it's bad in Indonesia, I guess you could say, but not as bad as it might be. That 8.5% drop in revenues translates into about a 5.5% decrease in per capita transfers just to districts. We're just looking at districts here and not anything else. So here's the picture of what's happening to the total transfers of revenues. You see since 2001, how transfers have increased rather significantly, almost by a factor of 3 in real terms. The blue bars are just the nominal amounts of transfers. And the green line there is transfers in real terms. So you see the 8.5% drop in transfers brings us back to about 2018, what the situation was in 2018. So to examine the impact of the COVID-19 on district spending, we have specified an econometric model, which we will not go into, obviously. It posits that district spending as a function of intergovernmental transfers and various controls. Based on that model, we estimate that a 1% decrease in district transfer revenue leads to about a 1.1% decrease in district spending per capita. So the 5.5% decline in district transfers that we're assuming would lead to about a 6% decline in district per capita spending. So if you look at the picture, this, sorry?
3 minutes, please.
3 minutes?
Yes.
That just won't be possible, Acho. I'm sorry. I'll do the best I can. So this shows the very tight relationship between transfers and spending. It's just the simple scatter plot, but I think it shows you the extent to which district spending is very tied towards transfers. So our estimate for household spending, we're basing our estimate on work done by our friends at Smeru, Surahadi et al. This is an article that will appear in BIS, if I can give a plug to BIS very quickly. Their estimate is that a 1 percentage point change in economic growth is associated with a 1.5% change in household spending per capita. And so that translates ultimately into about a minus 7.6% in decrease in household spending. So here's what we want to look at is the impact on household access to services. This is just the simple histogram. You see that it's a simple average between enrollments, attended births, and household access to water and sanitation. The average is about 74%. It ranges from 20 to about 90. So here is a summary of the intermediate effects. Economic growth will decline by about 5.45 percentage points. Central government revenues by about 21.5%. Transfers per capita minus 5.5%. District spending per capita minus 6%, and household spending minus 7.6%. Those are the intermediate impacts. Now, to examine the impact on household access to services, we've got a model that specifies the change in access to services as a function of district spending, household spending, and a bunch of other stuff. And we then simulate the impact of a simultaneous 6% decline in district spending and a 7.6% decline in household spending to see what the impact on services is. Here it just shows you the general relationship between district spending on the left-hand side and change in service access and household spending on the right-hand side. Two things of note. Those red lines are quite flat. The relationship we find in our model is that they are statistically significant, but the slope is not very steep, right? Suggesting that the impact, while significant from a substantive point of view, is rather limited. So ultimately, here's what we find. From the baseline, all else being equal, the counterfactual is that access to services would increase by about 1.83%. That's what the data say, that's what our model says. And then the estimated impact based on our econometric model is that from the baseline, household access to services will decline by about 2.21%. So that is not a very large impact. It is a rather muted response through those two channels. Lots of caveats, so let's not go into them too much. These are just averages. There's bound to be a lot of geographic heterogeneity. There'll be differential effects depending on the extent to which districts are reliant on own source revenues, places in Bali, for example, how district budgets are reallocated, the effects of the downturn on provincial spending, which we are now looking at, and in particular, the impact on the quality of spending. We're just looking at the impact on access and not quality impacts, which may be quite severe. The government policy has so far focused on maintaining the level of village transfers. The dana desa has not been cut, and on expanding conditional cash transfers, among other kinds of things. So we ask, should government increase intergovernmental transfers to provinces and districts, as many have advocated? We suggest probably not. We don't think it's a good idea for the following reasons. Central government is already running a reasonably high budget deficit. We prefer not to contribute to that deficit to increase transfers. The district needs will be asymmetric, and let's face it, the central government has not shown itself particularly very capable in addressing the asymmetric needs of districts. Subnationals have significant financial reserves or rainy day funds. If ever there were a rainy day, it is today. They should be drawing down on those subnationals. And in particular, you'll see from that flat slope of the relationship between access to services and district spending, that district spending is rather ineffective overall in terms of addressing increases in service. As Masyita mentioned, there is a crisis loan program in the making. So far as my understanding that no disbursements have been made. In many ways, this makes a little bit more sense. At least it relies on districts to make the first move. There is a long and largely unhappy experience with district borrowing in Indonesia. Districts have not much appetite to borrow, and even less appetite to repay when they do borrow. So here are our conclusions briefly. I'm going to finish up now, Acho. This is my last slide, promise, so it won't be long. So we estimate that the combined downturn in district and household spending, which we estimated, which we're using in the simulations, results in an only 2 percentage point reduction in access to local services from the baseline. Why is this? This is because of two very well-known stylized facts of local public finance in Indonesia. One is that districts spend their money quite inefficiently. They have quite substantial, at least some of them have quite substantial funding, but they do not use that money very effectively to increase access to services, rather one. The second stylized fact is that household payment taxes and user charge payments are not very much. They don't spend very much. Own source revenues are very weak in Indonesia in terms of the aggregate budgets. And so there is a rather weak link between local tax and charge payments and the increase in access to services. So this points to some other structural factors which may in fact be more important than district and household spending. The initial conditions in which districts find themselves, population size and density, poverty rates, level of economic activity in general, a variety of district fixed effects and unobservables, especially political ones, in determining local service delivery. And of course, social distancing itself is likely to have some impact on the access to services. People are staying inside, they're not going to school, they're not going to puskesmas, etc. Potentially more larger impact on services relates to the quality of services. That we don't know yet what's happening, but it's likely to be rather large. We find that an increase in intergovernmental transfers is unnecessary at present because of the aforementioned reasons. A crisis subnational loan program would perhaps be a better idea, but significant challenges exist to unrolling that kind of program. Thank you very much. Sorry for going over, and we're happy to answer questions if you have any. Thank you.
Thank you, Blane. So now we move to Q&A session, and I'll first take 3 questions for this first round. On my list, I have Fania Budianto, who will ask directly, and I will read 2 questions. So while Fania is preparing, I will read question from Heath McMichael, who is asking Steve and Roland. Can you say something about the idea of a standby loan to Indonesia by Australia? For example, how much, and alone or with other countries or multilateral banks? There are some questions about the idea of having Dewan Moneter or Monetary Council. This was asked by Rahul Bajoria from Barclays, and also Inka Yusgiantoro from Atmajaya. Probably Steve or Roland and also Pak Dede can comment on that. And now let me give the microphone to Fania. Fania?
Acho, Fania is not available to speak. So if you could read her question.
Okay, where is her question? I think the question goes to Masyita. Let me find it. Yeah, what do you mean when you were talking about unified database of beneficiaries on the poverty database? You mentioned about inclusion error is more dangerous than exclusion error. Can you please explain or clarify? When crisis hits, even those who are above 40% are suddenly become poor, and the UDB, Unified Database, cannot capture this. A lot of workers who suddenly lose their jobs are just above the poverty line. So what is wrong with inclusion error? So let me start with Steve or Roland.
I'm going to suggest Roland certainly answers the first one, and as far as I'm concerned, I'd be happy if he took both those two.
Okay.
Okay. Thanks, Steve. Can you hear me?
Yep.
Acho? Yep.
Yes.
Okay. Thanks. Thanks for the question, and thanks also to Acho, Blane, and ANU for this event. Quickly, it's always a highlight of the calendar. Look, just quickly, I'll try and cover off an answer to these questions, and Steve can jump in if necessary as well. On the question of the standby loan, this is something that Steve and I have both suggested would be, a particularly useful policy instrument where outside partners could play a role in helping Indonesia finance its way through the pandemic. This is something that's been previously done. It's pretty much it's a loan made available to the government to help finance the budget deficit. It's called a standby loan because it's basically available if market conditions are basically too expensive or have deteriorated out of proportion to normal. It's something that's been done previously in response to the global financial crisis and the taper tantrum as well in 2013. And the beauty of the mechanism is supposed to be that by making them funds available, it improves market confidence. The government will be able to finance its budget deficit. And that then actually means that maybe the loan will never actually be called upon in the first place, because the market will then finance the budget deficit because it will have the confidence to do so. The challenge today is that it's just that the size of the COVID shock is much larger for Indonesia than the GFC or the taper tantrum ever were. So those previous facilities, which involved the World Bank, ADB, Japan, and Australia, were $5 billion facilities in US dollars. Clearly, that's too small for what Indonesia needs today. So the question is whether or not that could be scaled up in some way. We've argued that it could be. It's difficult to say what the multilaterals could necessarily do because they're already trying to do as much as they can do. Maybe they could stretch their balance sheets further. I'm not sure about that. But from the perspective of Australia, there is more that I think the Australian government could do to provide that kind of financing to Indonesia. Previously, Australia committed about $1 billion, so it needs to be a lot bigger than that. But what the government did last time was it made those terms what I would call semi-concessional. We basically said we would pass on whatever the borrowing cost for Australia was onto the Indonesian government. And that meant that it came at some fiscal cost to the Australian budget. So one way to go a lot bigger would be to try and remove that fiscal cost. And our suggestion would be that what you could do was you could say, okay, well, Indonesia doesn't actually need aid or concessional financing at the current juncture. It can stand on its own 2 feet. What it needs is to be able to access normal rate financing. And if we provided it at normal rate financing, then the fiscal cost to Australia would actually be extremely minimal. In fact, we might actually, in terms of cash flow terms, make money because we borrow at a cheaper rate from the market because Australia has a stronger credit rating than we would be lending it on to Indonesia. So I think that's an option if the Indonesian government wanted to go down that path and if the Australian government was willing to go down that path as well. And I think the signs are that there has been some consideration given to that. But very quickly, maybe perhaps, and others can speak to this, perhaps Indonesia also the government might be interested in relying on BI itself, because of course that gives it a lot more autonomy in what it's doing. Quickly on the question of the Monetary Council, I guess the issue that comes through from all the speakers, not just Steve, but also Pak Dede and even Masyita, is that whether or not deficit financing from the central bank is a problem depends on whether or not it is temporary or whether it becomes a persistent and excessive and overly relied upon instrument. And to me, the risk is that if you go with establishing a monetary council where the government, through the Minister of Finance, is basically in charge of setting the direction of monetary policy, then you increase the odds significantly that you'd be going down this path where it doesn't end up being a one-off financing from the central bank. It becomes something that could become regular, and that's when you would start to get problems. So central bank financing, if one-off, if temporary and at the market rate, not such a big deal, in fact quite helpful if it enables the fiscal stimulus and support that is needed. The problem is if it becomes a regular thing. I think the risk here is that if you do undermine Bank Indonesia independence so explicitly by changing the governance structures, then that becomes more likely. And just as a final point, I think the risk is that, say there is another risk-off event, say markets get the jitters again, there's more dislocations in the bond and currency markets, then what will happen? Will BI have the credibility then under a different arrangement to be able to intervene so strongly in order to stabilize the currency, in order to stabilize bond markets, but also make sure that the government can finance the deficit? So I think those are some of the issues there.
Thanks, Roland. Steve, do you want to add something? No? Do we still have Pak Dede?
Yes, I'm here.
Okay. Any comment there?
Oh, okay. First, I think on the Monetary Council, of course, I cannot talk on behalf of the government. So Masyita is here. She can talk on behalf of the Ministry of Finance. But one thing that I can share with you, last Friday, Minister Sri Mulyani made a press conference and she made it clear that the government will retain the independency of central bank. Yeah. The proposal about this monetary council came from the parliament rather than government. And probably, as you know, in Indonesia, if you want to produce law, there should be an agreement between government and the parliament. So the response from the government, according to Minister Sri Mulyani's press conference last Friday, the government would like to retain the independency of Bank Indonesia. And the idea is mostly focused on the supervisory of the banking sectors, exactly what Steve and Roland mentioned in their presentation, rather than independency on this monetary policy. Just one thing that I would like to add, seems to me that if the burden sharing is, the time frame is clear, one-off, is limited, tradable, and marketable. And then if you look at the scheme, it is very interesting because the government still pay the coupon, not zero coupon, but the Bank Indonesia pay back to the government using rebate. So the interest rate still prevail. So that is why, in my view, this kind of model still work. But if the government continue doing it, become unlimited, that it might create an issue because it will erode the capital of Bank Indonesia. And there is a risk that Bank Indonesia will not be able to conduct the monetary policy independently because they will concentrate on the balance sheet rather than monetary policy. I think I leave it up here.
Thank you, Dede. Masyita, you can comment on that monetary council also, and then the inclusion-exclusion error question from Fania, please.
Yeah, thank you, Pak Acho. So as Pak Dede mentioned, that last Friday, Minister Sri Mulyani have explained that the discussion was coming from the DPR side. The government is focused on maintaining BI credibility, effective and independent monetary policy, because we see a lot of risk coming from not doing that. And Indonesia has been, like, in terms of fiscal and monetary, in the global investors are deemed as credibility is quite high. There's also another thing about burden sharing during the press conference. First, burden sharing that, that the government doesn't pay interest, but actually there's an interest, like Pak Dede said, but the BI repay the government. That's the one-off. The ones that's until 2022 is that BI can be a standby buyer should market volatility increase tremendously in the primary market. But that's only limited for certain conditions and will not be used easily. For the exclusion error, I agree with Fania. Maybe I mentioned it wrong. So during the pandemic, it's more dangerous to have exclusion error, to have people who's supposed to get but don't get the additional social benefit. Inclusion error, of course, we want, there's no inclusion error, but in this situation, we care more about exclusion error and expanding the database. Because we only cover around 38% of the bottom 40%, close to 40%. But then, as Fania said, also after the pandemic, people on the higher decile actually can fall below poverty line, and everyone's income with the furlough, with the declining in income, has felt tremendously. That's why the social safety net was expanded. Not just the amount, but also the number of beneficiaries. Another thing about the DTKS is that, for example, like in the Ministry of Agriculture, we have poor farmer data that is not linked to the DTKS. So these are the things that will be improved further so that we have one database so that when we want to extend or give a social safety net, we can go directly. Thank you.
Thank you very much, Masyita. So for the second round, I have Loland McCall from DFED, who will ask directly, and also Naufal from Dana Reksa. But before that, I'm going to read a question from Dika Merdikawati from ANU. Dika is asking a question to Masyita. President Jokowi recently made public remarks about the importance of prioritizing management of the pandemic. Are we expected to see changes in the policy direction from then on? How the pandemic management will be done differently? Any breakthrough in pushing for improved testing, tracing, and treatment of COVID-19? So that was question from Dika, and now let me call on Loland McCall from DFED to ask his question. Loland?
Thank you. I wrote my question down earlier, but I locked and unlocked my computer and it seems to have disappeared. So I have to ask a slightly different version. It's in regards to burden sharing and the forecast from Bank Indonesia and Deutsche Bank about an increase in inflation. So there was a paper in 2010 by Professor Randall Wray and Scott Fulwiler, which argued that US quantitative easing wouldn't lead to inflation because in the context of the American, Australian, Japanese and British banking systems, lending is an endogenous rather than exogenous process. And in practice, banks don't actually lend out reserves as we commonly assume. So the increase in the base money supply doesn't lead to an increase in credit growth, broad money aggregates or inflation. Do we know for certain that Indonesian banks are going to be lending out the newly created reserves that Bank Indonesia has created in order to buy these bonds in the primary market? And if not, and if the newly created reserves are not going to actually be lent out by Indonesian banks, doesn't that suggest that the forecast increase in inflation from the increase in the quantity of money is perhaps inaccurate? Thank you.
Thank you, Loland. Naufal, are you there? Naufal from Dana Reksa, please. No? Okay. If not, there is a question from YouTube from Ibu Mailing Oi to Blane Lewis. So what do you think of today's Kompas reporting a new policy to discontinue testing of asymptomatic people? What are the long-term potential consequences on health and the economy? So those are the questions for round two. So Let me first ask Masyita to respond to Dika's question.
Thank you very much, Dika. This is a very important question, but yet very difficult to answer always. So there's two sides of this pandemic, right? First, from the Ministry of Finance perspective, we would like to make sure that budget can stand ready to be more flexible, to adjust with different circumstances. So, right, with the Perpu, which is now become Undang-Undang Number 2, 2020, we increased the budget deficit. So we want to make sure that budget is not an issue for this year to tackle the health issues and also the social safety net expansion. On the health part, of course, we see that Indonesia curve is not flattening, and hence President would like to see some improvement in the tracing, and then we're also working on the vaccine as well. And of course, increasing the number of testing is also important, because Indonesia, even compared to peers, compared to Philippines, number of people getting tested per number of population is still very, very low. For the inflation question, I agree with you. I mean, we don't see a lot of risk from inflation coming from the demand side, right? Because demand is low, BI is creating money supply. However, credit growth has been really low. Even before the pandemic, there's a slowdown in credit growth, and now it's even lower. And then second, if you look at the restructuring loan, now many of the loan is loan at risk, right? And this loan at risk, some of them will be translated into higher non-performing loans. So banks will be very careful in giving out credit, which is why I agree with the first presentation, which says, Steve, that monetary policy can only do so much, right? Of course, it helps in terms of the burden sharing and all, but then money created sometimes are held in the banking systems and not lent out to people, which is why the only game in town is fiscal policy. Monetary policy have limitation. You cannot push private sector to improve or increase production, right? Because there's no demand. That will be not profitable for them to do so. And then you cannot push lower middle income people to spend more, because their revenue has gone down as well. They have limited budget to spend more. People who actually need to spend more is the higher income people, right? But they also are being very careful. So everybody being rational about their own situation. If they have cash, then they hold it, like what happened in the global investors as well. That also happened at a personal level. But those who wants to spend, they don't have enough income because their income has gone down significantly. So I think the only risk to inflation, what I see, is that if there's a disruption in the supply of food or bawang or cabe, beras, right? This will create an increase in inflation from the supply perspective. But from this demand and credit creation and money supply creation, I don't see a lot of risk on that side. Thank you.
Thank you, Masyita. Steve or Roland, can you take the question?
Roland, have a go at it.
Okay, Roland.
Yeah, hi. I'm not sure I need to say anything after Masyita's response just now, which very much covered it all on inflation, I think. The only thing I'd add, I suppose, is, this comes down to a question of whether or not you think the supply shock is bigger than the demand shock, and I don't think anyone really knows at the end of the day. So, I mean, forecasting is obviously a pretty difficult exercise normally, and it's only a guidepost at this point for the current crisis.
Okay, thank you. Blane, over to you, Blane.
Thanks, Acho. Thank you very much, Prof. Meiling. It's nice to hear from you. I'm afraid I'm going to have to plead ignorance on answering this question. Broadly speaking, first of all, I didn't have a chance to see Kompas this morning, and I'm not a health expert by any means. Firman Witular will be addressing this and other questions in subsequent presentations. So I think he'll probably give a much better answer than I could. I mean, I would just say that, you know, it sounds like something that Trump may advocate in the US, you know, let's not do any testing, therefore we will have a fewer number of cases. And obviously that doesn't make any sense. And even people who are asymptomatic need to be tested, because even though they may not be experiencing symptoms, obviously they can pass the virus on anyway. So it sounds like, without being very familiar with what the report says, that it doesn't sound like a very good idea.
Thanks, Blane. So now let's move to the third round. I will invite Astrid Kartika to ask her question to Blane, also Puspa Amri from US. But before that, let me read a question from Saiful Mahdi from Universitas Syah Kuala in Aceh. This is to Blane. As Dana Desa transfer has not been cut, what is and will be the impact of this, if any? So that's for Blane. And then let me invite Astrid Kartika.
Well, thank you for the opportunity to directly ask the question. So, Pak Blane, it was always good to hear your views on Indonesia's fiscal decentralization issues, especially during the COVID-19 response. So my question is related with the issues around data accuracy that Fania has raised earlier, and also the social protections of financing, whether this is something that can be considered to be integrated into the subnational transfer. So whether it is a good idea to integrate this into the overall regional transfers in Indonesia to help boosting economic recovery and addressing data accuracy issues quickly. Because there are issues around data, as we know, and then this being managed centrally actually poses its own challenges. So appreciate your thought, Pak Blane, on this. Thank you so much.
Okay, Puspa. Puspa, you're there?
Hello.
Yeah, hello.
Hello. Yes. Thank you, Dr. Patunru. My question is for Dr. Masyita Crystallin, and maybe Dr. Dede Basri would like to chime in as well. I'm curious what kind of feedback mechanism the government, especially Department of Finance, is using to get a feel on how effective are the various aid programs that have been designed and delivered. I know there's a whole range of them, especially on the MSME front, UMKM front. There's a whole range of them, from very small credit below 2 million to higher up than that. And I'm appreciative of all of the regular, transparent communication that the ministry has been conducting on this space. But if you have any sense of what are the ones that have worked so far and what are the ones that haven't, that you could share with us, I would really appreciate it. Thank you.
Thank you, Puspa. Let me start with Blane.
Okay, thanks, Acho, and thanks, Saiful, for your question about Dana Desa. Given that it has not been cut, what will be the impact? Not too much is my view. I mean, you know, the Dana Desa #1 is quite small relative to transfers to districts especially, and to provinces as well. The funds flowing are much more limited in scope, #1. 2, it's not really the village's responsibility to deliver the kinds of health and education and infrastructure services that we're talking about in this presentation. So it's very unlikely to have any, it's very unlikely to us that village spending will have much impact on those kinds of services at all. Now, we do understand that village governments are using their funds perhaps to make cash transfers to households, and also that they use them for some kinds of small-scale infrastructure projects, which padat karya kinds of things, where they can generate income for households. So those kinds of things may have an impact through household spending. But overall, my view is that that impact would be rather limited. The second question was from Astrid. Astrid, thanks very much. Nice to hear from you. About could social protection kinds of operations be integrated with the transfer system? You know, in a way, you could say that they already are, because the districts are responsible for social protection across a variety of dimensions. And, you know, most of the transfers to districts, either through the various revenue or tax sharing programs or through the DAU, can be spent at the discretion of the districts, right? So they use their money in part to address social protection concerns already. And as you are probably aware, some of the DAK, some of the special purpose grants are geared especially towards social protection. So I would say in a way that funding for social protection is already integrated quite well through the transfer system. Now, if you are asking, should the central government create yet another specific purpose transfer for social protection purposes, I would say no, for two reasons. One is that the DAK system is already very well fragmented. I think one of the last things we need is yet one more DAK transfer to the subnational governments. And number two, as we reviewed in the presentation, it doesn't seem like, broadly speaking, district governments use their money very effectively to address social protection or other kinds of services. So thank you, yes.
Thank you, Blane. Next, may I have Pak Dede's response to Puspa?
Thanks, Acho. Puspa, we have to wait for the data because I think the government started to disburse the money probably on July or August if we want to see whether all this program effective or not. But let me talk from speaking from my previous life. Yeah, if you look at the absorption capacity, it is quite clear that the social assistance, you know, the ability to absorb on the social assistance program is more than 50%. So it is more likely the cash transfer will be very effective. And that's my experience as well during 2008 and 2013. So cash transfer will be effective. The second one is also experience from 2008, credit guarantee, because the problem in the banking sector now is not about liquidity. The liquidity is there, but credit crunch. So if the government, you know, can provide a guarantee through a Ascrindo like 80% and 20% from the banking sector will lend money. That's what we did in 2008 during the global financial crisis. So the Exim Bank would lend the money to the exporter. The program will not be effective is tax incentive. Why should we give a tax incentive when the economy is, you know, running with the negative growth? If the company do not have profit, they don't pay tax anyway, right? So that kind of program. So that is why I propose it's better to stop the tax incentive program and reallocate the money for the cash transfer.
Thank you. Masyita, do you want to add something to that?
Yeah, thank you, Dr. Puspa, for the question. So as Pak Dede mentioned, we are still in the disbursement stage. And in fact, some of the stimulus package has issues or it's hard to disburse the amount that has been allocated. For example, for health spending, the disbursement has been slow, and also for the lending through the banks. So what we did is we lowered the credit risk for bank to do by putting money in banks, but banks still have to bear part of the credit risk, right? So we bear part of the credit risk and bank bear part of the credit risk. And under current circumstances, banks do not want to bear any credit risk because they know it's very risky. And in fact, the ongoing credit is already most are already at loan at risk. So the one that goes through the banking system will have more challenge. For the MSME, the big part of our support goes through our own BLU. So we have Mekar and UMI. Those are the lending below 20 million, below 10 million. In fact, the majority of the lending is only below 5 million per person. So these are the bigger part of the program for SMEs that has been disbursed quite quickly and effectively, and this is for productive measures. We are currently working with several agencies, World Bank, Prospera, ADB, with LPM, etc., to work on the effectiveness of the policy. But now we are still in the disbursement stage, and but survey has been conducted, for example, for the social safety net, whether if you supposed to get the social safety net, do you get it, how many percent get it, and where you are in the income decile, etc. That has been started, the survey. But for the effectiveness or the impact of the policy itself, we need to, I think, wait for probably next year to see real impact. But as Pak Dede said, during these circumstances, the demand side support, especially social safety net, especially cash transfer, is the most effective and fast. And it's been everywhere in other countries as well. Thank you.
Thank you, Masyita. I believe we have time for one more round, and that goes to Rizky Siregar, UC San Diego, Rafi Akbar, University of Glasgow, and Gerrit Gonchorek from University of Freiburg. So let me call first Rizky.
Hello, everyone. Thank you, Pacho, for for giving me the opportunity. It's really nice to learn from everyone. I'm Rizky Siregar from UC Davis. So I think it's okay. We're in California. First question is actually, I want to link what the proposal stated by Prof. Dede to the government, basically, and perhaps Dr. Crystallin, Masyita can answer to that. So given the constraint that we have limited capacity from the government side, also, which social safety net or which program that the government will prioritize? That's the first question. Like, we learned from your slides that there are tax forgiveness or tax cut, social safety nets in terms of cash and in-kind. So is there any choice that you will expand a certain type of social safety nets? The second one, in terms of health sector disbursement, will the government pay more attention to it, given that despite the effectiveness of any social safety net will also depend on whether the health sector is actually recovering. The third question is, if possible, is there any possibility or interest for the government also to allow local governments to have bonds for them to not to have to some cyclicality in their budget, and will dampen the local conditions even deeper. Thank you.
Thank you, Kiki. Rafi?
Hello?
Yes.
Okay. Hello, everyone. Thank you very much for the opportunity. I'm Rafi. I'm a postgraduate student from University of Glasgow. I want to ask one particular question with regards of the targeting mechanism, as Ms. Masyita mentioned before. Like, I just wondering if the Indonesian government has any particular mechanism or solution for targeting mechanism in Indonesia, as you know that Indonesia has several issues in fraud. For example, many of the people claims to deserve the money or DLT, for example, like that, or corruption. Is there any particular solution from the government, or maybe Pak Dede could explain in his term? Is there any solution for this problem? Thank you.
Thank you, Rafi. The next one is Gerrit from Freiburg. I believe he has a question to Blane and Ruth. Gerrit?
Yes, can you hear me?
Yes.
All right. Thanks, Pak Adjo, for the opportunity. And yes, I have two questions to Blane, two really short ones. First of all, Thank you very much for this great talk, especially given all the data constraints on this topic still. I mean, you mentioned the challenges you're still facing, and they are obvious. But I have two short questions on this. So first, do you have any info on the pace of fund disbursement, and if or how it is affected by the crisis, maybe in comparison to previous years around September? And also, do you think this crisis will affect much needed reforms to Indonesia's intergovernmental transfer system, and maybe the willingness to go further with this, even given the current challenges due to the crisis? Thank you very much.
Thank you, Garrett. Masyita, I think you have a couple of questions there, so can you go first?
Okay, thank you, Pak Acho. So Kiki, it's nice to hear from you. First of all, in this situation, cash is king. So in-kind, electricity subsidy, type of subsidies in the format of commodities or consumption support is second best to cash, right? But we are working in an environment where you only have limited data. For example, the PKH, the Family Hope Program, cover only bottom 20 or 25%. But we need to cover more than what the PKH cover, right? PKH have until account number. So you can just increase by 50,000, for example, and then you can just transfer it to their account. And then the next 15% of the bottom population above PKH, you get sembako, right? Sembako support. This portion of the population have also account number already in the DTKS data. What we did is that when we realized that the shock to consumption and income of household will be huge, but data is limited, as Pak Dede said. Pak Dede has a good a note in Compass, suggesting using other types of data. But what we had at that time is two alternatives. First alternative is electricity subsidy data. This is covered bottom 40%. So the coverage is larger than what have been covered by the PKH. And then second, we have the BPJS data. So we analyze both data, and then apparently the ones that ready-made and you can just directly give a subsidy directly in terms of electricity tariff payment is the electricity subsidy data. So this is of course second, third, fourth best scenario, but during that position we have no data and we need to give additional support to consumption as soon as possible. Okay. So what to do next? This is linking to Rafi questions on fraud and stuff. Maybe my guru Pak Dede will add on this, right? You have this between speed and governance, right? And during crisis, you also need to be very fast, but the government has been very, very slow because of the governance that we created to protect ourselves from fraud, of course, right? But during this period, we try to manage in between. Of course, it's not as fast as the government expected to be because there's issue with data and some of the social safety net expansion. You need to verify whether they already received other type of social safety net, and sometimes the data is not linked, not matched. So there's a lot of difficulty in doing that, but we did the best we can. That's why for the additional, we add from electricity subsidy, electricity tariff. The data set was originally from DTKS, but because the data is not online, after 5 years or 3 years, the data has already been different. And the dynamic of the data, the updating process is also not, you can say it can be improved more. Right? So from the social safety net, data is key, I think, because otherwise you cannot make better quality spending, because we still have several subsidies such as subsidy pupuk, fertilizer subsidy, and the fuel, although we don't have subsidy, but we have compensation, for example. This type of commodity subsidy is regressive because richer people consume more, right? So they get more subsidy. So we need to take out from this subsidy and move it to more productive, such as PKH, but that's need an adequate data that's always updated. For the bonds, for the subnational government, there has been a very serious discussion since several years ago. In fact, several local government has already started to talk more detail about this. But when that happened before the COVID, also happened before this, US-China trade war. So at that time, the market was volatile and it was too expensive to go on with the plan. But I think we need to be, the subnational government, of course, have option to do this, but need to be careful because they also have different cycle of election, right? So you want to be careful between mingling with the politics and also this economic, because then if you want to have a longer term bonds to build infrastructure, for example, then it will go over several election period, which is not sometimes not favorable for politicians in the subnational government as well. So there's a lot of issue there, but of course, a region has options to do that. Thank you.
Thank you, Masyita. Pak Dede, any quick response?
Yeah, if the institution still in the Jurassic Park, don't recommend policy like a Star Wars. It's not going to work. So my answer to Rafi, the data is not perfect. So we have to work within constraint. Let me give an example. Not many people realize in 2008, 2013, when we conducted the cash transfer, people had to queue for 5 hours for 150,000 rupiah. Not many people realize that was useful. Why? Because if you are come from the middle and upper class, you are not going to spend 5 hours only to get 150,000 rupiah. And based on that, we can identify who is the poor, that kind of model. That is why I also propose like Kartu Prakerja. Everyone criticizing this Kartu Prakerja, but to me this is useful, because if the online program is useless, then we will know who will going to stay with the useless program. If they stay, it means they desperately need money. But if they drop out, they already have savings. So we can identify who badly need the money. The second one, you can do some sort of like a simulation using the telco data. Because using the SIM card, you can identify which people who spend about only 10,000 money on the SIM card, who spend about 500, 600,000 money. And even you can use the transfer through the pulsa on the SIM card. And then they can cash out at the Indomaret or Link Aja. That kind of model need to be sort of like explored. Last but not least, use the community base, because the Pak RT will know, all the poor people around that area. If you are interested, we wrote a sort of like, a short op-ed with Ben Olken and Remahana, on this particular topic. Thank you.
Thank you so much, Dede. So last but not least, Blane.
Thanks, Acho. And thanks very much, Garrett. Hello to you and to Guntur in Freiburg. So your two questions. Our information is that the transfer of funds from the central to provincial and district governments via the normal mechanisms, the revenue and tax sharing, the DAU and the DAK, has not been slowed significantly because of COVID. We don't have the information as of September, but Ruth tells me as of the end of June, disbursements were at 40% as opposed to 45% last year, so not too bad. I think the main problem on this end really is local government spending of the money that they have received. They tend to run up their reserves and pay just salaries until the last month or two of the fiscal year and then spend everything at once, pay off their contractors, etc. So I think to the extent that there's a problem with the funds flow, it's subnationals not spending the money that they actually have. Do we think that the crisis will affect the needed reforms of Indonesia's intergovernmental transfer system? Well, one can always be hopeful. I think the major reform that's needed on the DAU side is to get rid of that basic transfer, which allocates money as a function of the number of civil servants, and to make allocations based on a per capita instead of a per district need. And that seems to me to be unlikely affected by the crisis. We know that the Ministry of Finance already likes those two reforms. The major constraint in this case happens to be the DPR. Will the DPR have their minds changed on those two issues because of COVID? Seems rather doubtful to me. On the issue of the DAK, I think that the two major reforms that are needed: one, to collapse the number of DAK instruments. There are just too many. It's too fragmented of a system. Two, I would say I'm not a big fan of the bottom-up proposal-based allocation system of the DAK. Again, it's hard to see how COVID would change minds on those two issues. I mean, one can always be hopeful, but the lines of transmission from COVID to reform of the intergovernmental transfer system are not very clear. So thanks very much.
Thank you so much, Blane. So ladies and gentlemen, we're 9 minutes past the mark. So I'd like to thank all the speakers. It's been a wonderful session. I'd like to thank all the participants, the audience. I apologize to those whose questions were not answered today. Please join us again tomorrow on the topic of trade, labor, and poverty with a keynote from Professor Budiono and speakers including Dr. Chris Manning, Ms. Felipa Amanta, Dr. VP Alatas, and myself. Thank you.